welcome to an exclusive corporate treasury panel that ETCFO is doing in collaboration with Thomson Reuters on the sidelines of their corporate treasury roadshow in Delhi. On a day we have seen that the rupees touched a lifetime low, we have a stellar panel with us to decode the rupee for us.
We can say because there is a lot of momentum, people are, the fear has taken over instead of greed. It may move for 3 to 5% very short term or 3 to 6 months, then it will actually stabilize, because if you see, we are not in a situation like we were in 4 years back in 2013 when the current account to GDP had touched almost 3.5 to 4%. Now we are still below 2. So, I won't say rupee should remain weaker for long, but the fundamental takes time to catch up. And once the FI flows reverse, which is now negative territory, once it becomes positive and the stability of the next election, or there is some view on who is going to form the government for the next election, then it will stabilize. So, I would expect it is to first depreciate, then appreciate, then stabilize.
One of the differences this time from previous rate hike cycles of the US Fed, their central bank, is the fact that the other central banks are on hold. So that's the reason that the dollar is just moving up and up and up.
There are a lot of issues. I mean, the US has actually somehow managed to get out of sort of a deflationary situation where, you know, wages weren't picking up and so on and so forth. But it's suddenly now pricing in very high inflation. At some point, people might just say, look, the currency is getting overvalued. There isn't enough wage inflation in the system. Should the Fed, hike by as much as the market is pricing in now? So I personally think that the dollar is getting more and more into an uncomfortable territory. You know, the word overvaluation is a very tricky one, because it involves all kinds of judgments and assessments of what the fair value is. But we could see some support coming back from that front, where the dollar starts to soften a little and consequently takes the other currencies along with it. So I'm, in my view, where I'm saying that will settle in the 60s, 8-ish, at 68-ish level in the long term. I'm building in both the dynamics of the Indian external sector, and as Anil pointed out, we don't have the kind of current account imbalance that we had earlier, and also some caution about the US dollar's strength, which might just reverse when some concerns kick in. And most fundamentally, I think the US fiscal situation is likely to worsen with all these tax cuts and so on. And I think if you look at it historically, the dollar has never really strengthened for a long period of time when there's been fiscal pressure. So that is another thing that's working against the dollar.
The general trend is very similar to what Abik and Mr. Jaina have been saying, which is there is a view that the next 12 months are going to be extremely volatile, right? I don't think anybody is able to kind of put a finger on the pie in terms of saying where the rupee will finally land at the end of December or the middle of next year, because there are just too many factors which are at play, which has not been the case in the past. Things we're seeing with corporates is, compared to maybe 5-10 years back, is a lot more strict control over their hedging practices, right? So now most corporates that I know of or we deal with have very strong board-mandated, board-approved policies around hedging, and the whole perspective is this is not a play to make money. You might incidentally make money while taking some bets, but the primary bet is to hedge your positions, whether you're an exporter or whether you're an importer, depending on which side of the story you are. I think the second piece that we've seen is the accounting norms have tightened up in terms of how do you account for your derivative positions, how do you account for option premium, and so on and so forth. And I think that's forced corporates to take a little more serious view around the risk profile that the treasury actually takes on. And that shouldn't be disproportionate to its original function, which is to really manage cash and kind of hedge your positions. And the third trend we've seen actually is a lot of use of technology and tools.
How do you see risk management strategies in this very volatile, uncertain, ambiguous complex time.
Compared to 4 or 5 years back, when we did not really had any sort of regulatory control over corporates. Regulators always control banks, but never corporates. So now they have been very strict how much you can hedge, how much you can leave unhedged. So if you have above certain percentage of your exposure unhedged, then banks are forced to lend you at a higher rate. So you do not get that final rate. As of now, there is no systemic risk in the system. So again, I want to clarify myself. If you are seeing 72 in 12 months, it is really not depreciation. Today, 1 year is around 72, half 73. So if you are at 72 in 12 months, that means rupee has neither depreciated nor appreciated.
We think that the RBI is in a bit of a dilemma now, because what is happening today is again a little different from what used to happen in the past. Today, the price of a critical input, oil, and the dollar are moving in the same direction, which is hugely inflationary because we are big importers of oil. So I think at the back of the RBI's mind is not just this business of ironing out volatility, but I think there is some desperation to hold the rupee at a particular level and not let it cross into a territory where inflation pressures really move up very sharply. I think the RBI is in a substantially more difficult position now than it would be if oil prices had remained stable or if they were on a downward path, which is typically the sort of the dollar oil trade-off. So yes, but I think again, as Anil was mentioning, that that sort of daddy will come and hold our hand when it crosses a band of 5% over the RER. That thing has gone out of corporate treasuries, and I don't see anyone really expecting or tearing their hair because yesterday it was 68 and today it's moved close to 69. They see it as a part of the other thing is that I think a recognition of what is happening in other markets, and that the fact that the rupee's movement doesn't happen in isolation and is not controlled by the central bank, but it is part of a larger wave and so on. And again, this information revolution has enabled, and of course the participation of more trained professionals in the corporate treasury measures have, I think, sensitized them to the broader global movements, and seeing the rupee's movement and the RBI's inability to hold a certain level as part of a larger trend. Because if there is adverse sentiment against the rupee, and if you keep throwing reserves in order to against all EM currencies, and you start throwing reserves at the market to try and stabilize it, you just feed it to the sharks or the piranhas, and you just lose reserves. So the RBI will not intervene beyond a certain point when it sees it as a pointless exercise. That today is not seen necessarily as a part of the RBI's incompetence or its impotence as a currency market agent, but rather as reflection of a larger global trend.